Welcome back to Iron Financial. This is the explainer where we help you forge a much stronger portfolio, completely cut through market weakness, and build your long-term wealth on an unshakable foundation. I'm your lead analyst, and today, today we are hauling out the heavy machinery to inspect an absolute behemoth in the commercial real estate sector. We are looking directly at Realty Income, ticker symbol O. Make no mistake, this company is a towering, massive structure in the financial world. They boast a scale that very, very few competitors can even attempt to rival. But look, in today's high-interest, rapidly shifting macroeconomic environment, we've got to ask the hard questions. Exactly right. I'm the Market Skeptic, and I'm here to push for absolute 100% clarity. Because from where I'm standing, a 57-year-old framework is bound to show some serious wear and tear eventually. Investors constantly look at Realty Income as this invincible, untouchable fortress. But we have to wonder, is this massive structure finally showing fatigue? Are we looking at solid bedrock here, or are there deep structural cracks just hiding behind a fresh coat of paint? We literally need to know if this is a safe place to park capital for the long haul, or if it's a demolition waiting to happen.
So let's just cut right to the chase and ask the ultimate question for today's explainer. Is this hype, or is it real? I mean, they have literally trademarked the phrase, the monthly dividend company. Think about that for a second. That is an incredibly bold, almost arrogant claim to make, especially in a historically volatile market like we've seen lately. As a retail investor, I really have to wonder, is this just a brilliantly marketed trap for yield chasers? Because we've all seen what happens, right? Management teams prioritize that shiny dividend payout over the actual structural integrity of their underlying balance sheet. So, is this a true, weatherproof foundation for a portfolio, or are retail investors blindly walking onto a hazardous job site without a hard hat?
And that, my friend, is exactly the right question to ask. It's exactly why we don't deal in hype or raw emotion here at Iron Financial. We deal in cold, hard, unyielding numbers. We are going to audit the blueprints today. We are going to meticulously measure the yield, the debt, the margins, and the revenue. We're going to find out exactly how much weight this infrastructure can hold before it buckles.
And just to fully understand the sheer weight we are talking about here, consider the massive monolithic presence of that single-letter ticker O on the New York Stock Exchange. It has been trading there for over 31 years. Realty Income isn't just a casual participant in the broader market. In many real ways, it's a structural, load-bearing pillar of the S&P 500 Dividend Aristocrats Index. But look, a shiny ticker symbol and a fantastic trademark do not pay the bills. You know what pays the bills? Load-bearing capacity, cash flow. Today, we're initiating a totally no-nonsense, deep drill down into their Q1 2026 earnings report. We are going to aggressively stress test their capital deployment, their occupancy rates, and this highly complex new private capital ecosystem they're building, just to see if this operation can still support the immense, crushing weight of shareholder expectations.
Section 1. The Foundation. By the numbers. Let's dig right in.
Okay, before we can even begin to analyze the newest additions to this building, we absolutely have to inspect the foundation. And let's start with the ultimate proof of historical durability, the number 670. That is the exact number of consecutive monthly dividends Realty Income has declared over its 57-year history. Take a second and just think about the severe, brutal market cycles this framework has survived to hit that number. We're talking the dot-com crash, the 2008 global financial crisis, the pandemic economic shutdown, and the incredibly aggressive rate hike cycles from the Federal Reserve we just lived through. Through every single one of those massive storms, the dividend hasn't just survived, it has thrived. We've seen 114 consecutive quarterly increases. Guys, this isn't just a hot streak. This is the reinforced steel rebar buried deep inside their corporate concrete.
And you have to realize that remarkable consistency is backed by massive, truly industrial scale, an $87 billion enterprise value that completely represents the sheer heavy lifting this company performs on a global level. They operate over 15,571 real estate properties. That spans roughly 348 million square feet of leasable space. Think of the footprint. They are partnered with 1,786 distinct clients across 92 separate industries. We are talking about critical, essential infrastructure for household brands like Home Depot, Tractor Supply, Wynn Resorts, and 7-Eleven. They aren't just building a standard real estate portfolio. They are literally buying the ground floor of the global economy.
Okay, I see the massive scale. And I will absolutely acknowledge the history here. A massive 5,290% cumulative total stockholder return since their 1994 listing, yeah, that is undeniable. You're looking at an annualized return of roughly 14%, which heavily beats the S&P 500's 11% over that exact same time period. But here is my major pushback on all of this. Past performance is just an old blueprint. I honestly don't care how strong the building was back in 1994 or even 2015. I demand we stress test the current numbers. At an $87 billion enterprise value, the law of large numbers dictates that moving the needle and generating real actual growth becomes exponentially harder. Are they secretly bleeding cash right now just to maintain this facade? We need to actively look for cracks in the armor today in 2026.
Section 2. Stress testing the core. Q1 2026 earnings. Let's pull up the data.
Fair enough. Let's shift this explainer straight into the detailed financial drill down. We are pulling out the Q1 2026 earnings transcript and putting it right under the microscope. We need to see, factually, if the company is growing its core operations or if it's bleeding out. Well, the structural integrity is holding, and the numbers absolutely prove it. In Q1 2026, adjusted funds from operations, or AFFO, which, let's be real, is the true lifeblood cash flow metric for any real estate trust because it represents the actual cash available to pay dividends after maintenance costs, hit $1.13. That is a solid 6.6% increase year over year. And because of this incredibly strong start, management actually raised the midpoint of their full-year 2026 AFFO guidance by 25 cents. They are now targeting between $4.41 and $4.44. Hold on a second. I read the fine print in that exact transcript. A massive chunk of that, $40.2 million exactly, came directly from lease termination income. Look, when a tenant pays a penalty just to break a lease, is that really a sustainable growth engine, or is it a one-off patch job used to artificially inflate the quarterly numbers? Actually, scratch that assumption. It's more like a sign of highly proactive asset management. CEO Sumit Roy noted they have increased their full-year termination income outlook to a range of $45 to $50 million based on a highly visible, predictable pipeline. Furthermore, they lowered their credit loss outlook to just 40 basis points of rental revenue. That means almost nobody is defaulting. The core portfolio is fundamentally sound.
Okay, let's talk about finding new ground to build on then. They reviewed a staggering $31 billion in sourced opportunities globally, but they only actually deployed $2.8 billion. That means they are closing roughly 9% of the deals they even look at. Are they struggling to find deals that make mathematical sense? Is the commercial real estate market getting way too tight, making it harder and harder to find solid ground for capital deployment? See, I look at that 9% closure rate and I see ruthless, unyielding discipline. They aren't just blindly pouring concrete and buying up everything in sight. They are highly, highly selective. They deployed that $2.8 billion globally at a very attractive 7.1% initial weighted average cash yield. And you have to notice that $1 billion of that was specifically allocated to credit and structured investments. They are finding highly lucrative pockets of value, balancing their investments smoothly between North America and Europe, and completely walking away from the other 91% of deals that don't meet their strict ironclad standards.
And if you really want to talk about the load-bearing walls of this core portfolio, consider their historical rent recapture data. When a lease expires, are they forced to cut rent just to keep the tenant in the building? Absolutely not. Look at the numbers. In 2024, they recaptured 105.6% of previous rents. In 2025, 103.9%. And in Q1 2026, 103.4%. They are consistently, predictably, charging more rent on the exact same properties across multiple, constantly shifting economic cycles. Combine that incredible pricing power with an ironclad 98.9% total portfolio occupancy rate, and you can see that their underlying real estate is completely uncompromised. Their predictive analytics and embedded market data are actively driving better, faster, and much smarter leasing decisions across the board.
Now, let's examine the financial scaffolding holding all of this up. These are the core strength metrics of the actual balance sheet. They ended the quarter with $3.9 billion of pro-rata liquidity, which, in simple terms, is essentially their available, proportionate share of cash and credit. It is a massive pile of dry powder just waiting to be deployed. Their net debt to EBITDA, which basically tells us how many years it would take to pay off their total debt using their current cash flow, sits at 5.2 times. And if you include their outstanding forward equity, which is cash they've secured from stock sales but haven't officially drawn down yet, that leverage drops to an incredibly conservative 4.9 times.
Okay, I have to admit, seeing an A3 rating from Moody's and an A- from Standard & Poor's is legitimately impressive. You don't see that every day.
Exactly. Those A3 and A- credit ratings are the absolute gold standard in this space. It allowed them to issue $800 million of senior unsecured notes post-quarter, effortlessly swapping $500 million of that into euros for a highly efficient blended yield of just 4.44%. This balance sheet is an absolute ironclad framework.
Section 3. New Blueprints, the Private Capital Ecosystem.
But look, even with a perfect foundation, a company of this immense size has to evolve. And this is exactly where my alarm bells start ringing loud and clear. I have serious doubts about this new blueprint. Look at this differentiated growth drivers ecosystem. When a massive publicly traded REIT starts building complex off-balance sheet joint ventures and perpetual life funds, I really have to ask, is this a desperate move? Are they simply too big to grow normally through traditional public channels anymore? Is this just a forced maneuver to artificially inflate their deal pipeline because the traditional well has finally run completely dry?
It's absolutely not desperation, it is pure strategic optimization. Let's carefully dissect these three new vehicles so you can see what I mean. First, they successfully raised $1.7 billion in cornerstone equity for a U.S. Core Plus open-end fund. That's essentially a continuously operating private fund focusing on high-quality, stable assets with a little extra growth potential, fully backed by major institutional pension plans. Second, they established a joint venture with GIC focused strictly on build-to-suit industrial development. Third, a $1 billion programmatic venture with Apollo, which allows them to systematically partner on customized, high-yield debt deals as they arise. They are efficiently, brilliantly matching third-party capital to highly specific market opportunities. For example, in Q1, they deployed a $190 million data center loan in Virginia pre-leased to a hyperscale tenant. Think of the massive tech giants running the global cloud networks. They also deployed a $375 million mezzanine logistics loan, which is a specialized, higher-yielding loan sitting right between the senior debt and equity on warehouse real estate. These new private vehicles let them aggressively attack high-yield and structured debt in ways their traditional public balance sheets simply would not allow.
And to counter your skepticism directly, we really have to look at the words of the architect himself. During the Q1 earnings call, CEO Sumit Roy stated this explicitly. Quote, "Anytime we are exploring attracting third-party capital, it is with the singular intent to grow our earnings per share for our public shareholders." End quote. This isn't about hiding risk in the shadows. No way. This new structure is purpose-built to generate high-margin, capital-light fee income without ever diluting the core public shareholder base. They are managing other people's money. It is a highly lucrative management fee engine bolted directly onto the side of the main structure.
Let me make absolutely sure I understand the exact structural shift happening here. The traditional public equity model demands immediate gratification, right? It requires day-one spread investing accretion. Basically, if a property doesn't yield immediate cash flow right out of the gate, the public market ruthlessly punishes the stock.
Exactly. Hit the nail on the head. But the private capital model totally changes the game. It allows Realty Income to partner with patient, long-term institutional money, like heavy insurance capital, to invest in high-quality, long-duration assets that might have a lower initial yield but offer incredibly strong, long-term internal rates of return, or IRR. Previously, Realty Income was forced to just reject these pristine, mission-critical assets because they simply didn't fit the incredibly tight public market buy box. Now they have the specialized vehicles to capture them, own a piece of them, and earn a recurring management fee right on top.
And you might be wondering, why go through all the trouble of building these complex new vehicles? Because of this massive, mind-boggling number right here, $14 trillion. That is their internal estimate of the total addressable market, or TAM, for corporate-owned real estate across the US and Europe. Right now, there are literally trillions of dollars in extremely valuable real estate sitting passively on the balance sheets of leading global companies. Realty Income's new private capital blueprint provides the exact heavy machinery required to excavate immense untapped value from this massive space. They are acting as a natural consolidator on a scale that absolutely no one else in the entire industry can even begin to match.
Section 4. The verdict. Opportunity or trap?
All right, we've stress-tested the foundation, we've meticulously reviewed the Q1 earnings, and we've completely analyzed the new private capital blueprints. Now it is time to move to the final structural inspection. We are going to lay out a neutral, completely unvarnished summary of this entire Q1 2026 data drop, so you can forge your own conclusions. I'll start with the trap argument. The sheer overwhelming size of this company, an $87 billion enterprise value, means that moving the needle on growth is literally like trying to move a mountain with a tiny plastic shovel. This immense scale inherently makes traditional rapid growth incredibly difficult. And while the new private capital ecosystem sounds super innovative, it introduces undeniable operational complexity. Managing open-ended funds, joint ventures with sovereign wealth funds like GIC, and programmatic ventures with Apollo forces the company into complex, highly specialized maneuvers that stray very far from the simple, pure-play net lease model that made them famous in the first place. And on the flip side, we have the opportunity. You simply cannot deny the fundamental, overwhelming strength of the cash flow. We are looking at an A3/A- bedrock balance sheet with a highly conservative 4.9 times forward leverage ratio. They have delivered 670 consecutive monthly dividends and maintained a near-perfect 98.9% occupancy rate. Furthermore, these private capital vehicles aren't some dangerous distraction. They are brilliant new high-margin fee income engines that allow them to heavily expand their buy box and harvest value from a $14 trillion global market without putting any extra strain on their own balance sheet.
So, we leave it to you, the focused learner and the disciplined investor. We've laid out all the blueprints, and we've run the heavy stress tests. You've seen the unyielding dividend history and the aggressive new private capital strategies. The final inspection is entirely yours to make. Does this massive financial structure meet the stringent stress tests of your own personal portfolio? Does Realty Income actually belong in your bedrock? Market Skeptic, take these numbers, rigorously compare them against your own risk tolerance, and make absolutely sure you build your wealth on solid ground. That is all for today's explainer. Keep your foundation strong, stay disciplined, and we will see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.